Welcome to the deep dive. You're probably listening because, well, the idea of using the stock market for some extra income sounds pretty good, right? Especially if you don't have endless hours.
hmm
Today, we're zoning in on swing trading. It's one way people try to do this, and we'll see how it stacks up against things like day trading or options, which can be really intense.
Exactly. And swing trading, at its heart, it's about trying to catch those medium-term price moves. You buy a stock, hold it for maybe a few days, maybe a couple of months, not years.
Okay.
And our mission here really is to pull out the essential stuff about swing trading from the material we've looked at and, lay it out clearly for you, make it useful.
All right, let's dive right in then. For anyone who's maybe a bit new to this, what is swing trading? Fundamentally, it feels like it sits somewhere between, I don't know, super short-term trading and buy and hold investing.
That's a really good way to describe it, yeah.
Yeah.
You are buying a share and holding it, like a long-term investor would. But the big difference, the crucial part, is how long you hold it. We're talking days, weeks, maybe up to a couple of months. The goal is just to profit from those price swings, those ups and downs that happen in that time frame.
And I think one thing that catches people's eye is the time factor. It sounds like it needs less
Yeah.
constant watching compared to being glued to a screen all day for day trading.
That's a huge draw for many, yeah. The sources we reviewed suggest it demands significantly less minute-by-minute attention than intraday or options trading.
Okay.
You might actually find that, say, 15 or 20 minutes a day looking at charts is enough to spot potential trades. That's, a major plus if you're juggling a job or other things.
Could you maybe walk us through what a typical swing trade might look like, just, from start to finish?
Sure. So imagine you've done your homework, your analysis points to a certain stock, you buy it.
Okay.
Then over the next, let's say, 10 trading days, you see the price move up. It hits a point where you think, okay, that's a decent profit.
Right.
So you sell, you lock in that gain. Now, obviously, it's the stock market. It's not always predictable. Your analysis might be off, and the trade could end up being a loss.
Yeah, that's the flip side. Which brings up the really important, maybe less fun part. What do you do when a trade goes south? What are the options?
Well, the materials suggest a couple of main paths. If the price dips a bit after you buy, but you still strongly believe in your original reasons, your analysis, you might decide to just hold on, expecting it to recover.
Yeah.
This is where having conviction in your research really matters.
Okay.
But if the stock keeps falling and it starts to look like maybe your initial idea was just wrong, well, then the smarter move is usually to cut your losses.
Just get out.
Yeah, sell it. Free up that money so you can put it into something else that looks more promising. You don't want a small loss to snowball.
Makes sense. Now, you mentioned swing trading might be a bit more approachable than, say, intraday or options. Why is that? What makes it easier?
A big part of it is the time frame, because you're looking at daily charts, maybe even weekly charts.
Right, bigger picture.
Exactly.
Yeah.
You're not reacting to every tiny tick up or down.
Yeah.
This means that more basic fundamental trading strategies can actually work quite well. You don't necessarily need those super complex high-speed techniques that short-term traders often rely on.
Okay, so summing up the potential plus points based on what we've seen,
hmm
maybe lower risk than the really fast stuff, less time needed day to day, potential for regular profits from those swings, and analysis that's maybe a bit easier to get your head around.
That seems to be the general idea presented, yeah.
All right, so someone listening is thinking, okay, this sounds interesting. How do they actually get started? What's step one?
The sources we've looked at break it down into a few key steps. And the very first one, maybe the most critical, is actually finding a stock that looks like it has potential.
And I assume this isn't just picking a company because you like their ads.
Definitely not. No,
Yeah.
It involves getting into the charts. That's technical analysis. You're hunting for patterns, indicators, things that suggest there's a good chance the stock's price will go up within, the next few days or weeks.
Right.
But also because you might hold it for a bit longer than a day trader, fundamental analysis becomes more relevant too. Looking at the company's actual health, its value.
So both charts and maybe a bit about the company itself.
Yeah, a mix can be helpful. Our sources do say they plan to cover those analysis methods in more detail elsewhere, so that's worth looking out for.
Good to know. Yeah, okay, so you've done the research, looked at charts, maybe fundamentals, found a stock. What's next?
Step 2 is pretty straightforward.
Yeah.
Actually buying the stock. It works much like buying shares for a long-term investment, for delivery. The source uses an example of someone deciding after their analysis to invest, say, 1 lakh.
Got it. So you own the shares. Now, what's the crucial thing you need to do to manage the downside?
Right. This is absolutely key. Risk management, and
Yeah.
specifically using what's called the stop-loss order.
Stop loss. Okay.
The material really hammers home that the market can do unexpected things no matter how good your analysis feels.
Yeah, you can never be 100% sure.
Exactly. So a stop-loss is basically an automatic instruction for your broker. You tell them, if the price drops to this specific level, sell my shares. It's like a safety net.
So it puts a limit on how much you can lose on that specific trade. Can you give a quick example?
Sure. Let's say you buy a stock at €100 a share. You decide you're only willing to risk 5% on this trade.
Okay.
So you set your stop loss at 95. If the price falls and hits at 95, your order gets triggered, and the shares are sold automatically, hopefully around that price. Your loss is capped at about 5%.
Right.
The source material even mentions Mark Minervini, a well-known trader. Apparently, he often uses an 8% stop loss. The main point is having that predetermined exit point and sticking to it.
Discipline.
Discipline. Sounds like that's a recurring theme in trading.
Yeah.
Okay, so beyond the analysis and stop losses, when you're actually picking stocks, what specific qualities should you look for? Our sources point out several important characteristics. First one is liquidity,
Liquidity.
meaning how easily you can buy or sell the stock without your own trade massively moving the price.
Oh, okay.
The advice is generally steer clear of penny stocks or those really, really small companies. They suggest looking for companies with a market capitalization that's the total value of all their shares of maybe 4,000 or 5,000 core or more. These tend to be easier to trade in and out of.
Right. You don't want to get stuck holding something you can't sell easily. Got it. What's next after liquidity?
Volatility, you actually need the stock price to move.
Makes sense. Otherwise, there are no swings to trade.
Exactly. If a stock just sits there, trading in a tiny range day after day, there's no profit potential for a swing trader. Some people use tools like the average true range, ATR, to get a sense of how much a stock typically moves.
Okay, so it needs to be liquid and it needs to actually move. What's the third factor?
Ideally, the sources recommend focusing on stocks that are already in an overall upward trend.
Riding the wave.
Kinda, yeah. They caution against buying stocks that are just drifting sideways. You could tie up your capital for ages with nothing happening, or worse, it could break downwards and you end up losing money. You know, the saying, the trend is your friend.
Don't fight the tape.
You okay?
And any final point on selecting stocks?
Yeah, it's about finding stocks where you see potential for a decent-sized move. But, and this is important, don't just jump on a stock because its price is suddenly rocketing up.
Don't chase it.
Right. You still need solid analysis behind your decision. Avoid just buying into hype.
Okay, that gives a really clear picture of what to look for. Let's shift gears a bit. What about the downsides? What are the limitations or risks of swing trading people need to be aware of?
The sources highlight a couple of main ones. First, you might need a larger chunk of capital to start with if you want to make significant income, compared to maybe day trading, where you might aim for smaller, quicker gains. Well, think about it. A 10% profit on 1 lakh is €10,000. That's nice. It can supplement your income, for sure. But if you're looking for really substantial returns, you'd need to be investing a much larger amount to begin with for that 10% gain to be life-changing.
Right. The percentage gain might be good, but the absolute amount depends heavily on your starting capital. Okay, what's the second limitation?
The second one is something called overnight risk.
Ah, because you're holding stocks when the market's closed.
Exactly. Bad news can come out overnight, maybe company-specific news, maybe broader economic news, and that can cause the stock price to open much lower the next day. That's a gap down. It can happen suddenly and wipe out your expected profits or even make your losses bigger before you can react. Day traders avoid this because they close everything up by the end of the day.
That's a really critical difference. Okay, so given these risks, how do you manage them? What are the strategies?
The sources really emphasize 2 core risk management techniques. First, diversification.
Don't put all your eggs in one basket.
Pretty much, yeah. The key advice is don't pour all your trading money into just one single stock.
Right. Is there a suggested number, like how many stocks to spread across?
The recommendation we saw was maybe diversifying across 4 or 5 different stocks.
Okay.
The thinking is, if something really bad happens to one company, it doesn't wipe out your entire trading capital. Right. Hopefully, gains in the other stocks can help offset the loss in that one.
So it cushions the blow from any single bad event. Makes sense.
Yeah.
Wow, okay, we've covered quite a bit here in this deep dive. We've
Hmm.
looked at, what swing trading actually is, how you might get started finding stocks, buying them, using those crucial stop losses.
Yeah. And the criteria for picking stocks, things like liquidity, volatility, looking for that uptrend.
Right, and then the limitations like needing potentially more capital and that overnight risk.
And finally, managing risk through diversification and sticking to your stop loss plan.
Exactly. Hopefully, this deep dive into the material has given you, the listener, a really solid but also efficient grasp of swing trading without getting totally bogged down in jargon.
That's the goal.
So, as you think about this whole idea balancing the potential upside with those risks we talked about, it kind of leads to a final thought, doesn't it?
Right.
What kind of analysis would you personally lean on most heavily to feel confident about picking a winning swing trade? Would it be more about reading the charts, the technicals, or digging into the company's fundamentals, its real value, something definitely worth mulling over if you're considering this path? Thanks for diving deep with us today.